J. Anthony Boeckh, The Great Reflation, How Investors Can Profit from the New World of Money. Dive into the world of The Great Reflation, How Investors Can Profit from the New World of Money by J. Anthony Boeckh, where you'll explore the aftermath of the Great Recession of 2008 to 2009 and its impact on the American economy. Delve into the ways the government's massive spending efforts may have potentially set the stage for inflation and future financial instability. Discover the implications for investors and the importance of monitoring key signals to make informed decisions. To preserve your capital, learn about the history of currency and its link to inflation and asset valuation, as well as crucial investing principles like diversification, asset allocation, and the necessity for wise risk management.
The Great Recession and America's Great Reflation. The U.S. government utilized massive spending to avert the Great Depression during the 2008 to 2009 financial crisis. However, the effects of such spending remain uncertain, and it may lead to long-term instability in the American economy. This excess money may result in inflation and evoke negative past economic bubbles. The government's response is referred to as the Great Reflation, and only wise decision-making can put the economy on a more stable path. Investors should monitor signals to optimize their preserving their capital. In 2008 to 2009, the U.S. government's decision to inject billions of dollars into bailouts, stimulus spending, and tax credits saved the country from a potential Great Depression. However, the consequences of such massive spending remain unclear. The abundance of money within the economy threatens to create inflation, and echoes the negative trends of past economic bubbles such as the tech boom, the increase in home prices, derivatives, and commodity costs. The government's response has resulted in the Great Reflation, which may lead to future instability due to public and private debt, the shaky world economy, and a suspect dollar. It is crucial for the government to make wise decisions to ensure the economy follows a more stable path. As an investor, monitoring signals in the market can help make the best investment decisions. The flaws of a fiat currency. This summary explores how governments printing non-backed fiat money leads to inflation and increased debt. This behavior is seen throughout history, mostly when nations issue fiat money as a means of financing wars. However, it leads to hyperinflation and bubbles that ultimately crash an economy. The modern era of inflation began in the late 60s after rising gold prices and the subsequent unpegging of the dollar from gold, and since then, inflation has become a global economic fact of life. The Great Reflation plan helped increase asset prices, improving personal and corporate balance sheets, but this policy must be held in check to avoid a catastrophic increase in inflation. As a result of the recession, the U.S. is converting private debt into public debt, which results in continued fiscal deficits. The government must help keep the economy afloat by taking action that can increase these deficits and cause issues in the long run. Investing in the face of change. In the aftermath of the Great Reflation experiment, change will be the new norm in the financial world. As such, investors must prioritize wealth preservation by carefully planning, showing judgment, persistence, and caution. The injection of money into the system will create short-lived booms in certain assets and can be perilous, so it's essential to resist following the crowd. When investing, consider financial goals, risk tolerance, and investing horizon. Liquidity is vital for shorter-term investments. Investors must decide which assets to hold while considering a diverse range of possibilities like equities, bonds, currencies, gold, commodities, and real estate. They must also determine how much of any asset to allocate and when to adjust their investment strategies. The primary investing principle remains diversification. Mitigate risk by avoiding putting all your eggs in one basket. Although America's financial future is uncertain, the discipline of asset allocation and diversification will be crucial in helping investors select and protect their investments. Investing basics. Investment portfolios should have some exposure to good stocks to earn returns through value increases and dividends. Stocks are preferable to bonds over 10-year spans due to the higher returns at less risk. For tools help you determine when and how much to increase or decrease your equity exposure, market indicators, valuation, psychology, and statistical analysis. To evaluate bonds, consider their tenor and credit quality. For protection against inflation, consider Treasury inflation-protected securities. Gold is a reliable investment for times of financial catastrophe. Commodities are appealing for their negative correlation to stocks and bonds, while real estate is principally a home. Finally, the US dollar, despite its loss of value, remains the world's reserve currency, and investors should continue to purchase and hold it. America's future economic outlook. Modern economic upheavals in the U.S. have revealed financial and political failures that need addressing. Future trends aren't looking positive, with public debt and an aging population reducing the country's flexibility to overcome these challenges. However, by focusing on short-term investments in leading industries, such as technology and energy, and reducing its debt through cost-cutting and judicious tax increases, America can restructure its economy and achieve a brighter future. Investors should consider investing in equities of firms in commodity-producing nations, including Canada, Australia, New Zealand, Norway, Colombia, and Brazil. Small companies working with cutting-edge alternative technologies in the U.S. are also likely to offer the best returns.
In The Great Reflation, J. Anthony Boeckh highlights the consequences of massive government spending in response to the Great Recession of 2008 to 2009, and presents practical investing insights to help you navigate this uncertain era. It's evident that challenges lie ahead for the U.S. economy, with ever-growing debt and a polarized political landscape. Investors need to focus on wealth preservation, vigilantly monitor the markets for signals, and make prudent decisions to prosper in this evolving landscape. Wise asset allocation, attention to risk tolerance, and an eye on capital preservation will be crucial for success. The pursuit of promising investments, such as equities in commodity-producing nations or those working with cutting-edge technologies, can help carry investors through this period of change.